Hi everyone, welcome back to Seven Figures, the channel where we're comparing growth versus dividend versus Boglehead portfolios. It's been about 3 weeks since I last recorded my last episode, so sorry about that. I'm supposed to be doing one every week, but as you can see, last time I recorded my episode, I had about $11,000 in this portfolio, and now we're at 14,940, closing in on 15,000. So this has become a very serious portfolio. And as I promised, it's going to be getting about $150 in each one of these portfolios weekly. So $50 on Monday, Wednesday, and Friday. And for this episode, I really want to highlight the dividend investing portfolio and a way that it's shined through the entire volatility that we've had the last month or so, and how well it did when the market's going up and how well it's done when the market was going down. If you watched the last episode, episode 4, you'll see that it was the only portfolio that was still in a positive when everything else went negative due to the trade wars, uh, the rate cut, and all the noise that surrounds the market. So, been a very good, pretty good portfolio for me. And Boglehead actually disappointed the last time we did an episode. It was negative when the volatility was there, but it was also negative when we had growth. But today's episode, I'm going to take some time to go through all three portfolios, give you an update on how they're doing, show you that we've had quite a bit of money go into them in the last 3 weeks, about $3,000, and the performance of one of the slices in my dividend portfolio, as well as going through the growth portfolio and showing you the different companies that are doing well and those that are doing badly, because it's also good to share the downside. Now, starting off as always with the dividend portfolio, what you'll see is that so far we're up 164 and 11 cents, up 5.22%. Last time I recorded the episode 4, we're around $3,000. We're up almost to 5,000, and this has been the really impressive performer out of all three portfolios, due to the fact that it's been steady on the down. It's been steady when things were going down, but it's also been pretty strong when things are turning up. And as always, like I said last time, I look at this as me building my own index fund, but selecting the best companies that I believe in and also the leading companies, as opposed to relying on the S&P 500, which has really bad companies and also really good companies in it. So here are all the slices, which represent the sectors of the S&P 500, with the exception being that I do have something called alternatives. And in here, I have companies that don't necessarily appeal to everyone in terms of how they do business, mostly private equity companies. But if you look at all the slices, everything is in the positive. Financials up 3.9%. Bonds have been doing well, of course. Utilities have been probably the strongest performer, up 8.86%. Healthcare is up 5.6%. Technology is up 14.9%. And I'll look into that one to actually show you what's been doing well, surprise you what kind of company's been doing well in there. Industrials up 3%. REITs are up 8%. Consumer staples 4.5%. Consumer discretionary, obviously everybody's worried about recessions, so that's been pretty weak, but it's up 1.26%. Energy down 2.94%, but this was down even more like a week ago. I really want to put more money into this area because I think that it has a lot of potential upside down the road. And also the dividends that are paid are pretty high and I think pretty secure because all the companies in there are pretty majors. And then communications up 9.24%. This is probably mostly due to AT&T and also Comcast. And then lastly, the alternatives 2.69%. For this episode, I'll try to focus on the three sectors actually in this portfolio. I'll focus on the financials, the technology, and let's pick something negative. So we'll pick energy to go through and show you what's in there and what's been doing well. So starting off with financials, I really believe in this sector and I really want to just kind of dump a lot of money in here if I could, but I want to keep everything balanced across all three portfolios. And I do have my own private investing, so I can't just put all my money in this in this experiment that I'm running online. But Bank of America I'm targeting it to be 14% of the financials. Uh, Bank of Montreal, it's a Canadian bank, 14%. Wells Fargo, 14%. TD, another Canadian bank, around 14%. JP Morgan, 12%. Chubb, big insurance company, 12%. And I have some small caps in here in terms of People's United Republic Financial. That's about 10%. And First Horizon, which is a bank in Tennessee, around 10%. They both have pretty good dividends. And I think they're undervalued overall. If you look at the PE ratios and you look at their dividend payout history, they're pretty solid companies, even if they're small and they're regional. But the financials, I think, have been really beaten down a lot, and undeservingly so. We always are going to need banks. They've been around for a long time. They'll do well. And what I really like about Bank of America, Wells Fargo, and JP Morgan is right now they're raising their dividend. And if you're a dividend investor, the thing you want to be in is companies that are raising their dividend. So you get that yield on cost over time, which is as shares increase, your yield on cost actually increases significantly. So what you paid for the company today, they might be paying that dividend out fully, covering your entire investment 10 years, 20 years from now. So that's really what I'm looking for with the banks, because I think they've got a lot of ways to go and they're raising their dividends significantly. So that's really it for the financials, what's in there. I'll switch over and cover the technology. And this will surprise you in terms of which company is doing really well. So in technology, I only have 5 companies because it's really hard to find tech companies that pay dividends. And what I have in here is Western Digital Corporation. This is a memory company. It's up 62.32%. I really caught it at the bottom when it was really, really low. And it's gone up significantly. When I first invested in it, their dividend yield was almost 4%. But the cycle had ended for memory. So the dividend yield was pretty high. It's going to go down significantly because the share price has gone up a lot. The other one is Intel, 13%. Again, another old company that's been around for a while. They were beaten up a lot when I started buying the shares. And of course, Apple, one of the few big tech companies that actually pays dividends, up 15.4%. And then we have Broadcom. This is a semiconductor company, pretty broad company. As the name indicates, Broadcom. They buy up a lot of semiconductor companies. They pay a pretty good dividend. Large organization, key to almost everything that's made. So they've been doing pretty well. And the worst performer has been Cisco Systems. I think that they've just had a bad run right now. It is a blue chip company, part of the Dow. I think they'll probably turn it around down the road. But if you had to ask me which one I have the least belief in, it's probably Cisco, just because I don't really see a lot of innovation coming from them right now. And Western Digital is very cyclical. So it's up 62% right now. But if the memory market turns in the next 2 years, it might be down 50%. So not really counting on it to be a big capital gains growth company, but more of a steady dividend paying company. And then taking you back through here, obviously we're doing this live, so I'm not editing anything. Energy. This is an area that I really like, and I'm gonna try to invest more in because they're being beaten up right now. It's down 3.27% as a sector overall in my portfolio. And in here, I have some major companies. Obviously, I have Phillips 66, which is still doing well. Chevron is going to definitely turn positive. This is an undervalued company right now. And everything you read about them is they're all about returning capital to investors now and over the next 5 years. So that's going to turn it around. Total, which is a French energy company, reported really bad numbers not too long ago. So they went down significantly. But that gave me an opportunity to add in more shares. And I see a trend where a lot of international companies are undervalued compared to American companies. When you look at their PE values, it's always much lower, and compared to the U.S. counterparts. And I don't know what the reason is, but when you look at the underlying business, it's always pretty healthy. Royal Dutch Shell, for example, is almost as big as Exxon, but doesn't get the same valuation Exxon gets. It's down significantly, but they did report bad numbers. And then Exxon right now is not doing that well. They do have a lot of debt, and they haven't been growing top line very much. But they have a really healthy dividend. It's only up to 5% now. And then BP, which is paying close to a 7% dividend, which is kind of ridiculous. But their business is growing well. Their top line is going up, and they're expecting to have profitability go up every single year from now until 2023. So I think the dividend will be secure, and they'll likely continue growing it, which is the most important thing for me. Are they growing their dividend? Because that's what I'm investing for in this portfolio. Lastly is Occidental. They really got beat up a lot for buying Anadarko oil. But if you look at the underlying business, it's really pretty solid. Warren Buffett obviously helped them buy Anadarko with $10 billion that he gave them. Not a great fan of that, deal because by giving the $10 billion, he also gets 10% dividend on preferred shares, which is a really high dividend payout for giving that money away. They could have financed that deal at a much lower cost, but it is Warren Buffett. He can negotiate those things. But I think this company is going to go back up to the $80 range. Right now it's trading at 40 something. I just need to put more money into this area. But again, I'm trying to balance all three portfolios and not overweigh one over the other. And those are the three areas I'm going to focus on really on the dividend side. As you can see, the portfolio is doing pretty well, up 5.19%, $163. And if you look at it here, 27.44 comes from dividends, and 135 came from market gains. These could be wiped out anytime. I'm really focused on this, and it's been going up steadily. The last time I did a video, this was around $10 or $11. So they've been paying out a lot of dividends almost every day. I see dividends coming in. And just to be transparent, I'll show the activity tab so you can see how often money is coming into this account. So, 23 buys from 51.84. J&J paid a dividend yesterday. ExxonMobil, Chevron, all paid dividends. And you can see $50 came in on that day. $50 came in on that day. $50 came in on that day. These are the bonds paying out. This is Southern, Boeing, Amgen, and again, $50 coming in. So I'm consistently putting money in here, and this is one page. So you got to go through a lot of pages. But I'm confident that this portfolio is going to keep doing really, really well. As I said, I look at it as me building my own index fund or my own portfolio, not based on the S&P 500, but really picking the best companies that I think are going to do really well regardless of the time. Now I want to switch over to the growth portfolio. And here you can see, I'm so glad it's still negative because I don't want to show numbers that are just positive. So it looks like I'm someone who just makes videos when things are good. This is been a really big underperformer. And the more volatility has been out there, the worse it's performed. But long term, I think this portfolio is going to blow it out of the water. It's down 3.22%, but at one point this was up 12-13% when a few of these companies were on the upswing. This is obviously susceptible to market sentiment, but as you can see, the 11 companies in here, starting with Tesla, finally turning the corner, up 10.10%. It was down significantly just a few days ago, but I think this is going to be one of the big ones to carry this portfolio into a positive territory. Amazon is a company that's going to be here for a long time. Really big believer in them. Beyond Meat was the big driver of the growth earlier. It was up 55%. Now it's down 13%. But I like it. I think it's a company that's going to grow rapidly over the next few years. Google is still up in a positive territory. I'm a little worried about them with the antitrust stuff, but I think they'll figure out a way to get through it. And Facebook, I don't know why that keeps getting punished. Their numbers are always good. They're growing fast, and I think long term they're going to do just fine. I won't go through the whole portfolio. Go to Alibaba here. They're going to do well. I mean, China is on the rise. It's going to continue growing, and this company is not exposed to the U.S. that much, just the U.S. stock market. So all this tariff talk is not going to really affect them very much. And then when I go down here, one of my favorite companies, AMD, they continue being, undervalued right now, but they're taking share from Intel like crazy. They're going after Nvidia pretty aggressively, and I think they're going to be successful at taking share from Nvidia. Rightfully so, Uber is down 25%, and they've reported terrible numbers. But as I've said in previous videos, I invest in this company primarily because I like the product. I believe in the product. I use Uber every time I go somewhere. I hardly ever use taxis. If I'm not using my car, I'm in an Uber, or I'm in a train, or I'm in an Uber. So I think long term they'll figure out how to turn it around, similar to how I invest in Netflix. I mean, I don't care about Disney coming out with their streaming or NBC or anybody else, NBS or NBC. I don't care who comes out with their streaming service. I see Netflix in every country. It's easy to use. I've traveled with Netflix on my iPad, and I love it. I mean, the prices go up every 2 years, and I never think about switching it off. But I've gone without cable for nearly 5 years, so I think that they're going to continue being a good company, and they'll probably get through this period and continue dominating the streaming space. Not to make this video too long, I'm going to jump over to the Boglehead portfolio. This should be really short. I'm really happy to see that the Boglehead portfolio is actually in the positive. Last time it disappointed me because when we had a lot of volatility, this portfolio was in the negative. And now it's finally kind of turned it around. This is supposed to be the safe 50-50 portfolio. As you can see, 50% total world index fund, 50% total bond market. And both areas are now in the positive. Usually the total world has been lagging, and as you can see, it's only contributed $14.65 of the 48, while the rest has come from the bonds. So you can grow with bonds, and I think it's not a bad idea for people money in bonds. But it's been pretty steady. It hasn't gone down too much, and it's not gone up very much. As you can see, it's only up 1.44%. So it's doing all right now. I still think it's something you recommend to a 60, someone who's in their 50s or 60s as a steady portfolio. Part of the problem is I think that the total world fund doesn't do as well as the total US market. And I think in the last 10 years, the international part of the market has really lagged the US. So it's always kind of pulling this down. At the same time, I like it because it doesn't overexpose you to just US companies that dominate our market, like the Googles, the Apples, Amazons, companies that are approaching $1 trillion in valuation. Because if they go down suddenly, the entire market goes down. So a little more diversification. Maybe in the short term, you pay the price of not having a lot of growth. But when international starts getting valued properly, then you might see it actually perform pretty well. Anyway, long video for today. That's it. But I wanted to make a long video because I haven't done one in 3 weeks. If you like what you heard today, give it a thumbs up. If you like the concept and want to support the channel, please subscribe. Thanks and have a good day.